This shows you here that what I had spoken with before, kind of the trending in the yield on invested assets for the property and casualty industry. Doing very well in 2005. Of course, we went down during the recession there, or this in the 2009s, trickled down to 2013, and it has continued down to this point now with a few upticks, and really shown that there's no longer for rates to be the lower, longer type of expenditure. I can go to the next slide. So looking at some of the rating here, kind of exactly what I had described before. We saw in the 80s, right there in the middle, the high, completely even higher rating than what we're seeing now. Very, very tumultuous time for anyone placing coverage during those days. A lot of insurance captives were formed, a lot of insurance pools, reinsurance, a lot of uninsured risk, unfortunately, due to the cost that was available for the capacity. We saw it again dip down heavily for the competition, like we're seeing through 2004 all the way back to 2016, and now you see this sharp spike going up, which will probably touch what we saw in the early 2000s right after 9/11, which caused a lot of concerns. Let's hope we don't continue on up into what we saw during the 80s. You can go to the next slide. So for most lines of P&C, or property and casualty, continuing hard market existed way before COVID-19 without acceleration, except D&O rates and capacity for publicly traded companies were under severe pressure. That has now changed to the private sector. Is starting to see rating and capacity continue for rates to go up, capacity to go down, stricter underwriting terms and conditions, a lot of exclusions and endorsements are being placed on these. All great reasons for your brokerage team there at Heritage, for Art Illinets from a broker, and our team to help you assist what are the current terms and coverages, what is being put on your D&O coverage at renewals that could potentially be nefarious or just punitive to you in the future. A lot of communicable disease exclusions will start to be showing up on certain lines of coverage. We see that as well with workers' compensation, which is a line of coverage for anyone employees 3 or more is needed for statutory requirements to have that. Not as much of an issue for the industry and exposure here, but still something to be aware of. And then the reinsurance, which reinsurance is basically where insurance companies go to buy insurance to reinsure their exposures. And that is becoming increasingly tighter language around COVID-19. Also seeing a lot of exclusions and a lot of issue getting the capacity needed to make all the shareholders feel comfortable and continue to underwrite fair and profitable terms. COVID-19, again, is really impacting liability lines such as general liability, employers' liability, but the excess and umbrella markets capacity is under a severe pressure and will continue to increase probably through this year into the first and second quarter of 2021 at the expectations now, barring no second wave of COVID-19 and any other natural catastrophes that we can foresee. We'll go to the next one. So like we were saying here with the reinsurance, where insurance companies such as Travelers, Zurich, Selective, all these other companies go to purchase insurance is continuously going up. Perils are causing them to be nervous about different kinds of reinsurance. And so we're seeing the low single digits now to the low double digits continue to increase. A lot of firming continuing through 2020, probably into 2021. Let's just hope for a little bit of a loss-free year, and we'll be able to maybe minimize that. We were seeing at the beginning of this year everything starting to kind of normalize out, where it was going to continue to be a hardened property and casualty and liability market, but we didn't think any astronomical increases would be coming. Then COVID-19 hit and caused another influx of uncertainty, a lot of potential losses, as we just saw from Lloyd's of London's predictions, 107 billion, causing this to probably increase more than we had hoped moving forward. We can go to the next slide, Melissa. So one of the main coverages, of course, will be your liability, and then, of course, your property coverage for COVID-19 impacted. This right here is just your standard property and business interruption before COVID-19 here in the spring. As I've just been over, underwriters are inundated with providing renewal options. The brokers are looking for ways to reduce premium spend for you, the clients. But unfortunately, the normalized average rate increase for non-catastrophic, which you'll see there, non-cat, with no losses is 10 to 20% property increases. And then if there is cat prone or catastrophe prone areas, which are not an issue here for the majority of the Georgia locations we have, you would see 15 to 25. Now, if you've had your property coverage see a lot of difficult losses in the past, you could expect 30% increases, and it's not uncommon to see higher than that for certain industries. Again, due to this industry, not-for-profit, we don't foresee them being this high, but there will be increases on the property coverage this year. Capacity, again, was restricted. We're going to see reduction due to COVID-19, and underwriters are inundated with tightening up all their wording and are overrun with different submissions, as they call them. So when you submit your business, you fill out applications, it goes to a submission to an underwriter. They review it, they review the rate, they review the cost, the exposure, submit back quotes and terms, and they're going to pick out some of the best and brightest in that stack of files that they have or in their queue, as opposed to going with something that may or may not have been as a risk in the past. So that's kind of where we'll see that fall this year. You can go to the next slide, Melissa, please. So as I just stated, a lot of timing constraints for underwriters. Guidelines are changing. Leadership within the insurance market has made more stringent requirements, started to look at different exclusions, different reductions in capacity, and then there's challenged occupancies that we see. Heavy scrutiny again on reconstruction costs, engineering, open recommendations, fire control, safety. What are you doing? What kind of exposure do you have there on your potential property that could cause an issue with a claim or a loss and wipe out the premium that was charged? So that's kind of the issues that you're going to continue to see throughout 2020. Go to the next slide, Melissa. This again breaks down some of the rate increase, how you've seen this completely spiked here in the Q1 of 19 and then continued on through this year. The average right now is a 24% or so increase in rate up through March 31st of these projected renewals. We are yet to be determined, that we wouldn't probably share this with the insurance companies just due to the fact that this is a conglomeration of all the data that we're seeing, but it helps you with the budgetary expectations and different things that could fluctuate based on the market conditions, your underwriting guidelines, and then of course your loss history. You can go to the next slide, please. So I threw this one in here as well because it just shows you the quarterly rate change by type of account from year to date. It's going to be the number of insurers that are making changes, and of course, as you see there on the left, 35% are making changes, quickly and don't take anything else into consideration, reducing capacity and making rate changes by different types of accounts. So just gives you a fortunate snapshot that the majority of them, only a few, are not making any rate changes. We can go to the next slide, Melissa. And then if you'll see here, property, real estate, these have become very difficult markets and industries and exposures for the insurance companies to insure. So we'll see here, real estate is the highest one with the average industry rate change year to date from last year of 60%. So that 60% of all accounts have seen some form of rate change. It's not 60% increases, but 60%. So that that's not far off on what you'll see around that kind of property market. Transportation, of course, doesn't have a large property exposure, but then your medical, life sciences, and now your real estate are seeing some of these large rate changes per class and per business. So you can go to the next slide, Melissa. And then as we move into casualty, so this is probably one where you're going to see more of a potential coverage, and one that's going to be impacted more by COVID-19. So general liability is for a property damage or bodily injury type claim. So if someone has an injury claim and brings a suit from a third party against your association for, in this fact, negligence or some other factor relating to COVID-19, this is where you would turn in that potential loss covered claim. Again, every carrier is going to have a different stance. They were not prepared for COVID-19 or did not had addressed this directly in most of the policy forms. We never discourage, we always encourage any potential claim or claim to be turned into your insurance company for them to verify and deem whether or not it is a covered claim. But the majority of what we have seen so far, due to certain types of exclusions and being very difficult to prove bodily injury or a damage claim due to those exposures, don't have what we call a trigger on them to constitute coverage. So far, not seeing as many of these have a coverage as we would like to have seen if in fact a potential COVID caused loss. Automotive liability is continuing to increase, not a real issue for the exposures here, and the workers' compensation, unless you have employees of the association to be on your workers' compensation policy. Again, hard to prove that the employee contracted this while at your location or at work, and those usually, unfortunately, get litigated or will have to be further reviewed by the insurance company. Let me go to the next slide, please. This is one of the main unfortunate lines of coverage this year, besides property, that has had a huge, and I will say huge, and that's not just a vague term, increase. And we are seeing 40+%. We've seen 150%